Hi, we are looking at problem 526 from page 245 right now. There's going to be several videos. We're going to do journal entries, we're going to do the T accounts, and we're going to do the cost of goods manufactured and sold statements. I think this is a great problem for you to see the financial transactions. I mean, cost accounting is very much involved in the financial accounting system. I mean, it's where we get our cost of goods sold, our most important expense from. So process costing, job costing is what this chapter is mostly about. And job costing is really just keeping track of everything in a separate work-in-process inventory, and then that becomes the cost of that job, and then you do it again with another job. So job costing is really just about keeping everything in its own separate inventory account. So basically, you've got your direct materials that go into an inventory, your materials inventories. So you buy stuff and you make stuff, and as you make the stuff, it moves from the materials inventory into work in process or into overhead control, because it may not be a direct material. Then you've got labor, and you've got indirect labor, and then you've got some selling and administrative costs that actually don't go into overhead. So we're going to do these transactions right here, and we'll just see how these transactions work and where everything goes. All right, so I've got a journal. I've got my accounts, debit and credit column, and we're just going to go through each of these transactions and journalize them. All right, so the first transaction is materials purchased on account, $60,100. So materials, obviously an asset. You buy them, you stick them in your materials inventory. So that's an increase in the materials asset, therefore a debit. And, well, we got to pay for that stuff. We didn't pay cash, it's on account, so that's an account payable. So materials and account payable, $60,160. All right, our debits equal our credits. We can go on to our next transaction, which is materials issued to production to fill job order requisition. So somebody turned in their job order requisition form, they filled it out, and so now we're going to move these materials from the materials inventory into the work in process inventory. Direct materials, $50,000, so that's going straight into work in process. Indirect materials, $8,500, so that goes into overhead control. Okay, great. And of course, materials are coming out of the materials inventory, so that's your credit. So we have, I'm going to always abbreviate work in process as WIP, and overhead control. And then we said what? We're going to credit materials. All right, so that direct materials is the 50. The indirect materials goes to overhead con. And materials, you add those up, you got 58.8. Came out of materials inventory, so therefore is a credit to that asset. No longer in there. All right, C. Payroll for the month. Direct labor, $75,000. Indirect labor, $36,000. Admin, $28,000. Sales, $19,000. So this is a great example of some different kinds of expenses and some kinds of costs. All right, so direct labor, we know, goes into work in process. Overhead, we know, goes into overhead control, and indirect labor is overhead. However, admin expenses and sales are not overhead. They are going to be broken out separately on our income statement, right? So if you think about an income statement, you've got sales minus cost of goods sold equals gross profit minus selling and administrative expenses. So they're not part of cost of goods sold. Remember, what goes into work in process and what goes into overhead con become part of cost of goods sold. So we need for that to stay outside of those. So we're going to have separate expenses for the admin and the selling salaries. And of course, we're not paying them in cash. We're just going to do wages payable. So we've done our payroll. We just haven't actually cut the check. So let's do that. Okay, so that direct labor is just going right into work in process. So that is 75,000, right? And our indirect labor is going into overhead control, and that was 36,000. All right, and the other thing we had was administrative salaries, which were 28,000. So we're going to just call that admin expense. And then we had some sales salary, I guess commissions maybe, something like that. Sales of 19,000, so we'll call that sales expense. You add all these up, and that's your total wages, 158,000, and we'll call that wages payable, which of course is a liability which you increase with a credit. So 158. All right, let's draw a little line there. Sorry. All right, so D, depreciation on factory plant and equipment. Factory plant and equipment, that is overhead. So we're going to accumulate those depreciations and put those in overhead control. So overhead control, and the contra asset account, accumulated depreciation. Remember, contra assets increase with a credit. That's why they're contra assets. They do the opposite of an asset. So overhead control and accumulated depreciation is our debit and our credit, and they tell us the amount is 10,400. All right. E, we've got property taxes on the factory accrued during the month. So here's an accrual, property tax that we're going to have to pay. It just says we accrued it. It doesn't say paid. So we're going to call that property tax payable. And it's on the factory, so that's overhead. So we'll call that overhead control. And of course it's a liability, taxes payable, so you increase liabilities with credit. So taxes payable. And what did they tell us the amount was? $14.50. All right, moving on to the next transaction. Insurance on the factory expired with a credit to the prepaid insurance account, $6,200. Okay, so we've used up some of our prepaid insurance, so that's an asset. It's gone away. When assets are reduced, that's a credit. And factory insurance is overhead, so that's another overhead control. Right? And of course the asset we're reducing is prepaid insurance, and they told us it was $6,200. All right. G, what happens next? Factory utilities. So again, factory utilities, just the water, the electricity, stuff going on in the factory, that is overhead. So $5,500. So we owe that, I guess. Payable, we'll just call it payable. So again, our overhead control and utilities payable. Our liability increases with the credit, and it is $5,500. All right. H. What happens at H? Advertising paid with cash. Okay, so advertising is what we'd call a selling expense. All right, so that's not overhead. It's going to come out separately after the gross profit is calculated. So selling expenses are debits, and it says paid with cash. So cash is an asset which we decrease, so that's clearly a credit. So selling expense debit, and cash credit. All right, and it was 7,900. All right, so what happens for I? I is depreciation of office equipment and sales vehicles. Okay, so office equipment, that's admin. Sales vehicle, that's selling. So we're going to call that an administrative expense and a selling expense. And of course, our credit is the contra account accumulated depreciation. It's just different from this one because that was on the factory, so it goes in overhead. These are on an admin or selling item asset. All right, so admin expense, selling expense, and accumulated depreciation contra account. So 800 for admin, 1650 for selling, and if you add them together you get 2450. Yes, of course in real life there are sub-accounts and you wouldn't really put everything to accumulate depreciation, but it's okay. You get the idea. It would be separate out by asset. Okay, so transaction J, legal fees, so that's an expense but not paid for, so that's going to be payable. For preparation of lease agreements, so that sounds administrative and not like it's going into overhead. So the administrative expense of $750 needs to be recognized, or I guess accrued, along with a payable. So we're going to call that admin expense. And just an account payable, you might call it legal fees payable. That's not the point. We want to make sure, what we're really trying to make sure we're separating is overhead from selling and admin and work in process. All right, so admin expense and account payable of $750. K, I guess I'm running out of room. That's okay. For K, we have overhead is charged to production at a rate of $18 per direct labor hour. Records show 4,000 direct labor hours were worked. Okay, so we need to come up with work in process. We need to move the overhead control into work in process. So work in process is going to increase. And overhead control, right? And by what amount? 18 times 4. I'll just do this over here. All right, 18 times 4,000 equals 72,000. All right, so that work in process gets a debit of 72,000, and overhead control, we move out of direct labor, of all that overhead that we've been accumulating moves out, right? So it's like this and this, right, and this and this. Those are all moving now into our work in process. All right, and finally L. I'm just going to put it on this separate piece of paper here. L. Cost of jobs completed during the month, 160,000. So we are moving work in process out to finished goods. So finished goods is an inventory, also an asset, just like work in process. So work in process now becomes the credit because, well, we're taking it out of work in process, putting it in finished goods. So for L, it's going to be finished goods, which is an inventory, and it's coming out of work in process. So that 160,000, all right, goes right there. And that's it. We did the journal entries. So if you come and watch the next video, I'll show you how to do the T accounts.